Hi, my name is Jim Hilborn,
And I'm Tom Dinas.
and we are the Small Business Doctors.
And I've been taking care of business every day. Taking care of business every way. I've been taking care of business. It's all mine. Taking care of business and working overtime.
So, selling investment assets.
Yes.
Why do we want to do that?
Well, usually to make money.
Okay.
But these days, it's not such a great game. But one of the things I was thinking about doing this is like a lot of people don't know what an asset is, especially a capital asset.
Okay.
And the definition is quite broad as far as the IRS is concerned. So what they do is they state it in the negative. They say what's not a capital asset, and that is inventory, accounts receivable, and notes receivable in the trade or business, depreciable property, that's property in like rental properties and equipment in businesses,
Okay.
and copyrights held by the original holder. Everything else is a capital asset.
All right. So,
So-
an inventory, goods held for sale,
Right.
So,
is not.
stuff on your shelf, even though it's a couple of years old, would not be a capital asset. All right.
But everything else,
The shelf that you're putting
yeah,
it's a capital.
the cup,
Yeah.
the table,
Okay.
your jacket,
My
although
jacket.
not worth a whole lot, but
No, not a whole lot. Okay.
everything we own. And there's two classes of assets, capital assets, personal and business.
All right.
All right, you got that, Jim?
Got
this
that.
is the heavy
Got
stuff.
that. I
All
know
right.
this stuff.
We'll start with personal assets.
Can I tell you how much I love this?
I
But
know,
yeah,
I
yeah.
know. I can see it in your face.
Okay.
Your eyes are lighting up just
Yeah.
talking about this stuff. But personal assets is everything you own personally. I
All
mean,
right.
you're talking about your car, your rings, your motorcycles, your couches and chairs.
House?
House is a personal asset.
Okay.
It has all sorts of special tax codes and stuff we're going to cover in more detail as we go through this. And probably the most major asset Americans have in their life. Is
Absolutely. That'd
at
be
least
true for me.
historically, since probably the 40s, it's been the personal residence.
Sure.
So, and law says, tax law, that if you sell one of these personal assets at a gain, you have to pay taxes on it. So, like I inherited my mother's cocktail ring that she had made by an uncle who was a jeweler, and so she probably paid a couple $100 for it. If I sold that, and it's worth about $1,200 today, I would have to pay taxes on the difference between the $200 and the $1,200 I sold it for.
Really? Okay.
Yes, and that applies to every asset you have. Now, with vehicles, usually that's not a big deal because they depreciate, physically, and so you sell them at a loss. But with personal assets, you can't claim the loss.
You cannot.
No, it's a win-win for the IRS. You sell it at a gain, you're supposed to pay the taxes on the gain. If you sell it for a loss, you don't get the loss.
I'm thinking those people are not on our side, Tom.
I've heard that before. It's part of the conspiracy theory, people. But for the most part, and it isn't. It isn't. You think about some things, fair, unfair, and there are times when I look and a client has loss on something, and it goes, you can't deduct it, and they can't understand why. Well, it's the way the law is written. Some of it makes logical type sense.
Well, sure. I mean, how many times we really own anything that's going to gain in value?
Right. Very few.
Not-
No, we have coin collections, gold and silver.
Sure.
Sometimes stamp collections.
But certainly not clothes, not,
oh yeah,
not cars.
Unless you bought like something that turns out to be a collectible. But for the most part, it's all non-deductible stuff. So you get into the thing. Okay, so I'm going to sell something. How do you analyze it? And you'll hear the term basis, and that's the tax code term for what an asset is worth for the tax code.
All right.
All right, and the basis amounts to what you've paid for the asset, any major improvements that you put into the asset,
All right.
All right. So, and then there's adjustments if it's a business asset for depreciation. But for personal assets and most capital assets, if you're buying a piece of land or if you buy that gold ring or gold and silver, what you paid for it is your basis. So then when you sell it, you take that sales price, subtract out the basis, which we've now pretty well defined,
All right.
and subtract any sale costs of the sales, if you had commission fees or whatever, and that's what you pay taxes on. Now, if you had this asset for a year or more, it's capital gains, which gets a favorable treatment. Less than a year, you pay ordinary income tax on it.
So capital gains is good.
Capital gains is good, yes.
Ordinary income tax is bad. Okay.
Bad stuff, yes. So,
All right.
because
See,
you're going to
you
pay
didn't
more in
think I was
tax.
good
anyway.
at this, did you?
No,
But
no,
all right.
I thought you were just strictly a letters guy,
Okay.
attorneys. I
Yeah.
didn't think you had a mind like you do.
Exactly.
I've seen some of your emails, though. I'm beginning to get a hint.
So if I have a house and I buy a house for $100,000 and I remodel it and I put $150,000 or $50,000 in it, then my basis is $150,000.
100 plus up to 50 is 150, yeah.
All right.
Because you changed the numbers in the middle there, so you got...
Oh, yeah, I did. Okay, and I sell it and I pay say 10% for that's probably too much, but say 10% for the real estate commissions because I can do that math. So that's $15,000. So that means I have $135,000 then that I have to look at, right?
Right,
Okay, so if
Well,
I
that
sell
should-
it,
yeah.
that's just I'm just dead even at that point.
right.
Okay.
But now with the personal residence, you have all sorts of nice little code sections because the personal residence is a very key part of our economy.
Absolutely.
Housing starts, you'll hear, the economists talk about number of housings, and the sales of new and the sales of, previously owned homes. And one of the reasons why is the home is done quite well as part of the cornerstone of an American retirement plan and has for quite a few years.
Sure.
So it used to be there, and there's still a lot of misinformation out there about this, and I'm still surprised at how many people still, for some reason, remember old law. And when I say old law, I mean it's like back 20 years ago. But that myth, it's like urban myths. It's like the kids in the making out in the the forest preserves. They hear this thing and the hooked hand is on the door. That's the way it is with some of these tax law
That
things.
was true. That story.
Oh, really? Must have originated in Louisiana then, because by the time we got to Chicago, it was just way blown out of proportion. So they've added, and back then it was, you had this thing where once in a lifetime, you could exclude $100,000 a gain.
Right. I remember that.
Yeah.
Of course.
But then housing prices started ballooning, and things got crazy, and so Congress thought it was a good idea to institute a new law, which actually turned out to be a real godsend for a lot of my clients, especially those entering into retirement.
Right.
Because before, if you had a highly appreciated property, only $100,000 could be excluded. You wind up paying a lot of tax. And then there was a reinvestment. You could buy a house of equal or greater value and defer all the gain.
Exactly.
They threw all that out, scrapped it, and the new law is, as of this time, is that if you've lived in that house for 2 of the previous 5 years, lived there 2, you can exclude for a married couple up to $500,000 of gain.
Of gain.
So you take that $200,000 property, you sell it for $700,000, no taxes.
No tax.
You sell
Okay.
it for $1 million, you got $300,000 of gain.
Okay.
And you're going to wind up paying probably around $45,000 of federal tax
At the capital gains rate,
rate. That's right. If that was at ordinary rates, it'd be probably close to double that,
which is bad.
which is bad.
Yeah.
Universally, I say my clients, when they pay more taxes, are more upset
Bad.
with me than
We
when
think
they pay
that's
less.
bad. Small
Yeah.
business doctors.net. That is bad. Yes.
Right. So, so the new law I thought is very good. And then if you turned around and when we had the big run up in real estate values very quickly, people were turning around buying another place. They lived there for 2 years, and they could defer another $500,000 of gain.
Exactly.
And what also was happening were clients that had multiple properties and they were renting them out. They'd sell their house, move into one of the rental properties, live there for 2 years,
years.
sell that, live there for 2 years, and if the marriage survived the third move into another place and do that. They have limited that ability substantially, and so there's quite a bit of restrictions on that, much too detailed to go into for this session.
Sure, and if that applies to you, I know that there's some other rules about that 2 years doesn't have to be in a straight line either.
No,
it can
2 out of
It
5.
could be 6 months here, 6 months there, you know,
Right.
as I understand it, and so that
Yeah.
if you've lived there a year and a half, sometimes I've had people who are clients who've gone back to live in a house for 6 months that they've been renting out. They'd lived there for a year and a
Yeah.
half to have to go back and live there for another 6 months.
One of the big issues also becomes with elderly is that they'll be living in the house and then they'll move into a care facility.
Right,
And so you get into this very precarious thing of how long mom or dad is going to be in this care facility, and if they get beyond the extended period of time and they
Right.
sell, you might wind up having a huge tax bill.
right, exactly.
So lots of planning, once again, we try to keep you out of trouble. If you're getting into an issue like that, you really need to deal with a professional on a regular basis.
Exactly, and
need
you
to
know,
get
there's a
advice.
question like for older people that are they planning on coming back, and they're just sort of, is this just a hospice stay or is this just a rehabilitation stay,
Yeah, temporary.
which doesn't count?
Right, temporary.
And so there's a bunch of issues there, but you need to be aware of those issues. Yeah,
Yeah, and I've seen a couple cases where it got clouded and went past the time frame and cost the family a huge amount of money.
yeah,
And in that case, the only thing that I was going to say person that gains, the only entity that gains is the government.
right,
And also, you have to realize that every state, you always have on a lot of these transactions, especially now in real estate,
Exactly.
they've got transfer taxes now. You've got state income taxes, and whatever else they're going to be tacking on as they scramble around to get as much revenues as they can.
exactly.
So,
And so,
yeah.
state specific, you need to concern yourself with those rules. But the federal taxes, I've never heard of a state tax being greater than a federal tax. Could be out there, but the federal tax.
state
I've
of
never
Oregon
been.
comes pretty darn close.
Yeah.
Because we don't have a capital gains provision at all, so it all gets taxed at the ordinary rate, and we have the third highest in the nation currently. So it's 9%, which isn't all that much more than the 15% that would be on the
It
federal.
really isn't. No.
That shocks a lot of people, but some of the other states do very well, and they have a capital gains provision, or they have a much lower income tax rate. So,
Right.
once again, you need somebody that's local to you to give you specific guidance on this issue. But so the personal resident, and you'll still hear people talk about, oh, I have to buy another house of equal or greater value, and it's like, no,
Don't
no,
have
no,
to.
no, no.
Yeah.
Don't have to. That's all gone. You take that exclusion. That's it. And if you're single, it's $250,000.
If you're
And-
married, it's 500,000.
Yeah. And if you cohabitate and the property's owned jointly, you each get one half. So you each get to 250 or 500,000.
So it works out to be the
Works
same.
about the same.
Yeah.
But you also have to make sure that the ownership is correct on the title and everything.
Right.
And sometimes they'll transfer, they'll bring the significant other in a committed relationship and put them on the deed at a certain part of time, but that has to be on there for 2 of the previous 5 years.
2 of the previous years.
Yeah.
It has to be on the title for 2 of the.
Otherwise, you'll pay for the living in sin.
God. Thanks.
But
That's what we need.
that's right. So that pretty much covers the. There's going to be all sorts of little specialty things, and and that we can't even come close to covering. Like land that's attached to the house, and whether that qualifies for the exclusion, or multiple transactions. Where you sell off part of your residence, and and then the residence. So you once again, if you're going to do anything other than a pure vanilla transaction,
Right.
where you're going to sell your house. No title issues or anything like that, then but still get some advice. Make sure that you've touch base with an attorney or an accountant, and make sure that you're on the right track.
Exactly.
Yeah.
Exactly.
And whatever you do, if mom or dad calls you and says, I'm going to put you guys on the title in case something happens to me,
Yeah.
don't do it.
That's right. Big, because once you break the chain of title, that 2 years goes right out the window, doesn't it? Yep.
that's right. You have new people, and they're not living there.
No.
You do
So
not.
they'll never qualify,
They will never qualify. That's right.
but they'll screw up. That's a legal term. Your qualification, right?
It's like
That's a legal
I
term,
thought
yeah.
they only use that like in the East
No,
Coast
we use
Harvard
that.
type.
No, we
yeah.
use that in court. That's it.
Oh,
Yeah,
wow.
Yeah. but not a lot of people think they know what that means.
I don't know what it means sometimes, but I know it when I see it.
Exactly.
Oh. But now let's move on to other types of property. I mean, that's.
All right,
I
so we
mean,
talked
that's
about your
yeah.
house. All right,
We
okay.
talked about the house, but let's say it's just a rental property that you buy.
Okay.
All right, or a piece of investment land.
So a property you have purchased to not live in. You're not going to live in. Okay.
You're gonna hold it for investment. You know, rent
And
it
we have
out.
a show on investment property. We have a show on rental property anyway. You know,
Right.
landlord business.
So now you have all the same calculations as far as calculating the basis that we talked about, you know, cost plus improvements.
All right.
You have the same calculation as far as the sales price. You know, you're still going to sell it for X amount of dollars, you know, less maybe some closing costs.
Okay.
And the difference between that, you're going to calculate if you've got more money than, you know, more sales price than basis, you got a gain. If less, you have a loss. Now, if it's an investment property, you sell it at a loss, you actually can take the loss. There's some limitations to it. It's called either short-term or long-term capital loss, which means that there's some, and this limitation on capital losses actually goes back to the 30s. It's never been adjusted. It's never been a cost of living. It's been $3,000. If you don't, you know, you can offset your gains with your losses, and if you have more losses, the maximum you can take in any 1 year is $3,000. It's been that way for 45 years or whatever, 50 years. Yeah.
Ooh, 70 years or
Yeah.
more. Yeah.
So $3,000 a year, and you can use that up. You know, and you keep reducing it by 3,000. I have some clients who've had such big losses if they live to 100, they won't be able to lose them.
Yeah.
So, so sometimes you can do some planning on that. If you have other things in your portfolio, you can start selling it off because you can net that loss against other gains, so you can get that stuff out tax-free. So, the capital gains on that stuff, once again, is, you know, it's a good rate if you hold it over a year.
Over 1 year.
Yeah,
That's right. It's
or
got
more.
So if you're getting in the market and getting out of the market, or you're buying and selling real estate real quickly, then these, you know, this is going to be ordinary income to you.
Right.
Yeah.
And once again, rather than 15%, it could be 25. And
33. Or, yeah.
yeah, and you know, because as your income goes up, the tax law starts removing certain little goodies that it gave you at lower income levels.
Right.
So we have these gains, and if you sell it, cash out on the deal, you pay the tax. There is no reinvestment. That's another area of popular myth out there where people think, oh, I'll just buy another investment property and that's it.
Right.
No.
No.
Once you get cash, or what considered near cash, you know, if somebody, you know, gives you something unrelated, you know, like a car or, you know, a boat or something, you have gain. You have to recognize it in the year of sale and take the beating. I mean, that's it. There's no buying something else or reinvesting. Now, there are other provisions in the tax code that allow you to defer the gain. You will never get out of it. Only the personal residence is the only thing out there that you can actually get out of the gain completely, other than to die.
Other than when you die. That's
Yeah,
right.
you get
Yeah.
step
And
up.
that's
a-
a different game, folks.
Yeah.
Yeah.
And it's, you know, and it's a planning tool I don't really use a lot with my
Oh,
clients.
no, we don't
No.
like those. No.
Because I lose all the fees. You know,
Dying,
once
again,
they're
the dying
gone.
thing is bad.
Yeah,
Yeah.
that's even worse. The
Yeah.
death, taxes, yeah, both of
But
those.
it's a different tax game completely, because it fixes the basis at the time of death for some things, and so it's a, you know, it's just a different deal.
Yeah.
But we're talking about buying and selling while you're alive.
Right. And there you are, you know, if you, like I said, if you get the cash, you're going to pay the tax. So how do you get around it? You know, and fortunately there are, and you never get around it completely. You can defer it over a longer period of time, and if you, and plus sometimes get a better rate of return. Now, if you sell it and you get the cash, let's say you get a $100,000 transaction,
Okay?
and you pay $30,000 in taxes on it. You've got $70,000 left, and you can invest it where at what? Let's say you got 5%. Okay, so you're investing, you know, $70,000 at 5%. You're getting $3,500 a rate of return.
Okay.
But if you could stop that erosion of taxes and take that full $100,000 and get 5%, you're going to get $5,000.
$5,000.
Right. So the key is, how can we stop that erosion? Well, fortunately,
Oh,
page 3.
wait.
Yeah,
All right,
yeah.
okay.
There are a couple things that are available to the investor to defer taxes. One of the more common one is the installment sale. The installment sale says that if you sell a property and elect to treat it as an installment, which is basically automatic. you
Monthly
just do it-
payments, yeah.
Monthly payments or annual
Yearly
payments,
payments,
whatever.
but payments, yeah.
You only pay tax on the amount of principal that you receive. And now, most installment sales, you will get a higher rate of return than you can in the bank. And you're secured by the real
true.
estate. Yeah. So you can probably go from 5% to 8%. So now you're getting 8,000 rather than the 3.5 that the after-tax investment. And you collect on this contract, you hold the first position on the property. On real estate, it works very well because you can get the property back.
Exactly.
Personal property is a whole different thing.
It is, it's a
You
little
know,
iffy.
real iffy, and I don't see, Jim, you can address this, I don't see how you can really protect yourself on a personal property sale.
I think it's very risky and I'm not sure how you do either. I think that
I've seen-
that's the reason that interest rates are really, really high on personal property, like for vehicles, because they're fleeting objects. Like, you can take off in the middle of the night and go the other side of the country. Had some bad experience, clients, bad experience with RVs.
Yeah,
Motorhomes, that sort of thing, where, they sell them on a contract, and the next thing you know, the last I heard of the guy was in Dallas, kind of,
Right. I had a car I sold like that and got a call from a guy up in Washington saying, your car just ran into my Cadillac. I went, no, not my car.
No, yeah.
So,
And
but
so
yeah,
there's some tricks.
it's so it's really iffy, and I would tend to stay away from that. Real estate, you got to wind up with a first position mortgage on
yeah.
it. If they default, you foreclose on the property,
Mm-hmm.
get it back, and sell it again. I've had some clients sell the same property 2 and 3 times.
Sure.
You know,
And sometimes you can do that with businesses too. I know it used to be classic for the bar business.
yeah.
And I don't know if that's just real common or whether my clients, who just come from my clients, the same guy buys and takes back a bar 4 or 5 times. I mean, so,
Hey, he's working it.
yeah.
Now, another way to defer the tax is a thing called a 1031 or like-kind exchange.
Yep.
And that is where you don't really sell your property. You transfer it into what they call a straw man or straw company, and they hold that property until you find another one. And there's time limitations between identifying the property and how quick this transaction has to be completed. But once you find another property, the straw company buys the property, and they just transfer the titles.
Right.
And you get back the other property. And sometimes I have clients, they sold one property and got back like 3 or 4 properties.
Yeah.
Like kind is a very liberal definition under the tax code. It's basically real estate for real estate.
Exactly.
So you can sell raw piece of land and get an apartment complex or a commercial property. You can get anything except a personal residence that you're going to live in real estate.
Because it was meant for commercial transactions.
Yes,
yeah.
commercial
And
transactions.
so if I have a piece of commercial property or property that I'm not using as a residence and it's worth $200,000, I bought it for $50,000. Now it's worth $200,000. I can put it into this straw person, straw company, straw man, and get another piece of property that's worth $200,000 and not pay any tax for the transaction.
Right.
And
But-
my basis goes up, right?
No.
No, my
Yours
basis stays the
same. That's why
Oh,
it's a
darn.
deferred. Oh.
And so at some point, I am going to have to pay the
Yeah,
tax.
if you
unless-
ever dispose of that other property, remember we talked about basis, and in a like-kind exchange, you swap that basis for the other one, no matter what it's worth. And there's some adjustments that might be made based on the amount of debts that are against these properties. Under no circumstances, try to do this one on yourself.
No,
by
this
yourself.
is a complicated deal, and there are
Yeah.
companies out there that
Yeah,
actually
specialize in
that
it.
specialize. They're 1031
Yeah.
companies, so
And I'll tell you what, every time I get one in my office, I have to take time out and sit down and work through it
Yeah.
over and over again
Yeah.
and make sure I'm getting it right onto the tax
yeah, I've done a
forms.
couple of them, and they were just, oh my God,
Yeah.
it was staggering. I mean, I understand it a little bit, but I thought it was complicated.
Right.
And now that I know more about it, I think it's really complicated.
No
So
easy way.
you need professional help to do one, but it's a neat tool.
It is a very neat tool, and both the installment and the like-kind exchange are something that you need to be aware of. You don't need to know the specific workings of it, but just know it's out there. And so that if you get into the situation, you at least know to ask the question and get to somebody and say, okay, how do I put this together and how do I do it? And get some guidance. So,
Sure.
okay, now another way, some of my clients go, well, I like the installment thing, but I don't trust this guy and I don't want to get the property back because I think he's going to screw it up.
Right.
You know, and so how do I secure myself? You know, and it was, I came across this problem, you know, I think it was about 20 years ago now. It's not used very often and I'm not sure why. But the person, rather than giving you the money or giving you a note, they buy you an annuity contract. And so you get, you know, they go to an insurance company, buy this annuity contract, you get that, and the IRS has ruled that you treat that as an installment sale. You get, you know, you only
And
have
so
to pay
on-
on the principal.
Only as you receive the
Yeah,
money.
you're
Yeah,
not going to
yeah.
get as high a rate of return as
No.
you would if you carried the paper, but you're secure. You're home free on the deal.
An annuity contract means that I go to the insurance company, I pay them a lump sum of money, say I pay them $100,000, and they say, okay, Jim, every year I'm going to cut you a check for
Yeah.
$2,000 or whatever.
So that's it in a nutshell.
Well, thank you, Tom.